Good evening, everybody. Thanks very much for joining us again. Good to have you with us. This month, what I want to do is to take a look at the technical perspective for stock indices and the outlook for November, and whether or not latest activity has been a reversal of the more corrective, even negative themes that have dominated over the last few months, or just a reactive move, an unwinding of overextended downside conditions, and whether or not this can then resume more negative downside risks and see further selling pressure developing. Now, what I'm going to do is take a look at the US Tech 100 index as a bit of a proxy for global indices at the moment, and really sort of look at this and how that equates to other indices as well when we come to look at some of the other markets. So let's take a look at the weekly chart of the US 100 index. And this is up until a couple of weeks ago, where the market was within this corrective phase, posting lower highs and lower lows. And certainly, and I was definitely one of them, at this particular time, was expecting the risks for further weakness to develop as a correction was extended and a more extended retracement of this October 22 to July 23 move was seen. And really, that was reflected by the retracements of that upside. So we had the 38% retracement level standing at 13,937. And as a technical analyst, I would be looking for that as a potential correction support point and really reassess this corrective phase. Because if we start to test and break a 38% retracement level, we would then expect the market to encounter further selling pressure and move back towards the midpoint, even the 62% level. But certainly the 38% point would be a normal reactive move, and then we would reassess the risks, either reversal back towards the upside or, as I say, further corrective risks developing. Well, if we now update this chart to highlight the last sort of week and a half or so, we can actually see that we didn't hit this 38% retracement support. The market has rallied very sharply and very strongly over the latest developments, data that's come into the market, FOMC, that type of thing. And the market has rejected this corrective move in a very aggressive way. So we can see a very large positive candle developing last week to reflect that positive sentiment developing. But what can we use and what can we look at to assess how sustainable this move is actually going to be? Well, if we still look at the weekly chart, but draw on the Bollinger Band and really sort of highlight where we are within the current range of trade, we can see that the latest recovery, and last week we tested it, so far this week we've been above it, that being the Bollinger mid-average. And this tends to give us a slight pivot point in terms of where the directional risks are beginning to develop. And what has been more encouraging is that the weekly Bollinger Band is now starting to turn up to reflect the potential of a more sustainable positive trend developing. So that would suggest that perhaps the latest strength is just ending this corrective phase, and we can resume what has been a longer-term, more positive outlook. The problem with that is that when we look at, say, the daily chart, we can see that, yes, the sustainable rally, it's been a very strong upside move, is above the Bollinger mid-average on a daily basis, as well as the weekly perspective. And the mid-average is flattened out, having fallen, and may well be close to turning higher. But this pattern of lower highs and lower lows that you can see from July, September to October, forming lower highs, and August and October forming lower lows, is the basic definition of a downtrend. So from a proxy perspective, we still have bearish trending conditions evident within the US Tech 100, and as a result, potentially other global indices as well. So this pattern of lower highs, lower lows is still very much in place while we're below the October 12th last recovery high at 15,467. To the downside, the support should now be anticipated to be found at the mid-average at 14,890. So effectively, we're looking at these extremes as marking the evidence of where the support and resistance are coming into play. But then that resistance is increased further when we draw the downtrend connecting the recent highs, and that stands at 15,425. So we're effectively, having seen a very strong recovery within the US tech index, that has now pulled back to what is going to be a very important resistance focus, 15,425 up to 467, the trend line, and the October 12th last recovery failure high. And this is the point that I would be monitoring, almost a pivot point, if you like, because if we do start to break and close above that level, it may well be reflecting a more constructive backdrop from a technical viewpoint for global indices and the risk of further strength developing. However, on the flip side, while this resistance holds, and if we then back off and break below the mid-average, for instance, then that would suggest that we're still posting this bearish downtrend, the pattern of lower highs, and the risk of further extension that could even see a test of the October lows and even break them to extend this negative pattern. So by looking at the US Tech 100, we get an idea of where the risks are developing for global indices. And when we look at the following charts, just keep in mind that structure, because it is very similar. And I think sort of gives us a clear indication of where the risks perhaps tend to be and the levels that we need to be monitoring to the upside. And when we look at the US 500 index on a daily basis, you can see that we still have the same negative pattern of lower highs, lower lows dominating. The rally has been very strong. We've broken back above the mid-average, which is now flattening, which is constructive. But again, it's still this 4,430 October 12th high that is the important resistance level, while the support is the mid-average at 42.99. So effectively, the downtrend pattern is still in place, and that downtrend is actually higher than, we haven't even rallied back towards that point yet, of 44.93. We then draw in the Fibonacci retracements of this latest downside move, and the 62% level comes in at 44.39. So for the US 500 index, the important resistance point that for me would need to be broken to suggest that this rally is something more than just a reactive move to the upside before we start to see selling pressure developing is first 44.30 to 39, the last recovery failure high, and the 62% retracement. And you could even go on and say 44.93, the downtrend, is an even more important resistance that we would need to see broken. So I think the theme is that, yes, the rallies have been impressive, but further work needs to be done. And we really need to see an end to these downtrend moves to suggest that the risks are for a more prolonged upside. The Wall Street Index, very similar type of pattern, still looking at that lower high, lower low formation, the strong rally. And let's face it, it was a very, very important and impressive recovery that has broken the mid-average in this case, and that mid-average has now turned up, which is another more positive development. But again, it's still this October 17th high at 34,302 that is the important focus that we really need to be monitoring within this type of activity. So while this pattern of lower highs, lower lows is in place, the risk is that, and potential is that we could still fail and resume downside, and latest upside has just proved to be a reactive move from overextended downside conditions. And that, I think, is the general theme for the US markets. We need further evidence of a more sustainable upside move, and the breaks of these last recovery highs would be first indication of a more sustainable and prolonged upside move. So what about Europe and the UK? Well, if we look at the Germany 40 index and the UK 100 index in a second, the rally has been impressive. And in Germany, we have broken above the mid-average, but it's still falling. So that's a bit of still a concern. We would need to see higher prices to really start to see this turn around and start to move higher to reflect the potential of a positive trend. We're still below the last significant failure high within this negative pattern of 15,682, still some way above current price activity. So we could argue that this is still a more negative trending condition for the Germany 40 index and will be while we're below this high. Now, if we start to fail within this move and break back below the declining Bollinger Mid average, for me, that would be a concern, because often we can see that type of activity when the moving average doesn't turn higher and we then quickly break back below the declining mid average, that we see fresh acceleration to the downside. So if we do start to see 15,086 giving way, that would reflect further deterioration and the risk of a resumption of this negative pattern, with this point then obviously being the latest recovery high, being the last failure point of the downtrend. So watch this mid-average, and for now, watch this October high, because they could be the trigger points. So what about the UK, just to finish up for this week? Well, we haven't even broken above the declining mid-average in the UK 100 index. Yes, we've seen a rally, having tested these significant lows dating back to March, July, and August. The market has reacted to overextended downside conditions, but we're still below the mid-average, which is currently at 74.66. And while that remains the case, the pressure can continue on these lows, and November may well start to see further pressure developing. So there is a split between the US and Europe and Germany, Europe and the UK, in that the US markets have rallied significantly and they are threatening their resistance points, while Europe and the UK are not showing the type of strength that we've seen in the US. And for the balance of November, that may well start to see continuing pressure building and further selling pressure and downside developing. Certainly, if we fail at these last recovery highs within the US markets and continue to fail within the European and UK equity markets, then selling pressure can still resume and we can extend what are still more negative trending conditions. Break higher, that will change, and the risks can turn towards a more sustained upside move. But I think the evidence at this stage, from a technical viewpoint, is that we need to see those breaks occurring first. So that's me for this month. Thanks very much for listening. I'll be back in a month's time when I'll look at something else from a technical perspective. Thanks very much.